A lot of traders believe their biggest problem is the market. The strategy isn't working, the entries are off, the timing is bad, the market is unpredictable. But if you look closely at most struggling traders, a strange pattern appears. They don't just lose trades, they sabotage themselves. They break rules they already know. They abandon good systems after a few losses. They chase moves they promised not to chase. They trade bigger right after saying they would reduce risk. And afterward, they feel frustrated, sometimes even ashamed, because deep down they know something uncomfortable. They didn't lose because the market tricked them. They lost because they ignored their own plan. This creates one of the most destructive patterns in trading, what I call the self-sabotage loop. And many traders stay trapped inside this loop for years without fully realizing it. Here is a core problem. Most traders think inconsistency is a strategy problem. They believe they just haven't found the right setup yet. But in reality, most traders already know what they should be doing. They know their risk rules. They know their entry criteria. They know the importance of discipline. The information is not the problem. Execution is. The real issue is that traders repeatedly act against their own plans. Not once, not occasionally, but in patterns. They break rules during emotional moments. Then they regret it. Then they promise to be disciplined next time. And then the same thing happens again. This is not random behavior. It is a cycle, a predictable psychological loop that quietly destroys consistency. I call this pattern the self-sabotage loop. The self-sabotage loop happens in 4 stages, and once you recognize it, you will start seeing it everywhere. Stage 1. Good intentions. Everything starts with clarity. The trader studies, they review charts, they write rules, they promise themselves, this time I will follow my system. Confidence feels strong at this stage. The plan looks clean and logical. Stage 2. Emotional pressure. Then trading begins. The first few trades don't go as expected. A loss appears, then another one, or the trader watches a huge move they missed. Now emotions begin to rise. Frustration, fear of missing out, doubt, urgency. The plan still exists, but emotional pressure begins to challenge it. Stage 3. Rule breaking. Eventually, the trader bends one rule. Maybe they enter slightly early. Maybe they increase position size. Maybe they skip their confirmation signal. It feels small. It feels justified. But this is the moment the loop activates, because once one rule breaks, others follow. Now the trader is no longer executing a system. They are reacting emotionally. Stage 4. Regret and reset. Eventually, the trader realizes what happened. The trade fails. The loss hurts more than expected. And the trader thinks, I knew I shouldn't have taken that. This creates regret, sometimes even anger toward oneself. So the trader promises discipline again. They reset, and the loop quietly begins again. This pattern shows up in many small but damaging behaviors. A trader misses a breakout. Price moves without them. Instead of waiting for the next setup, the mind says, I can't miss this. So they chase the trade, right at the worst moment. Another trader has 2 losing trades early in the day. The third setup appears. Normally they would take standard size, but now frustration whispers something dangerous. I'll go a little bigger and recover. The size doubles. The emotional pressure doubles. The decision quality collapses. Another trader watches social media and sees someone posting a massive win. Suddenly their own system feels slow, boring, too conservative. So they abandon the plan for one aggressive trade. That trade usually becomes the one they regret the most. These moments feel isolated, but they are not. They are pieces of the same loop. The reason this loop happens is not lack of knowledge. It's emotional pressure combined with identity. Most traders tie their sense of competence to their trading results. When trades fail, it does not just feel like losing money. It feels like losing control. The brain tries to fix that discomfort quickly, so it pushes the trader toward action. More trades, bigger trades, faster decisions, anything that might recover the emotional balance. But emotional recovery is not the same as strategic recovery. In fact, it usually pushes traders further away from their edge. This is why self-sabotage is so dangerous. It doesn't feel like sabotage in the moment. It feels like urgency, or confidence, or determination. But underneath it is simply emotional pressure driving decisions. Professional traders experience the same emotions. They also feel frustration. They also miss trades. They also take losses. The difference is what happens next. Amateur traders react to emotional discomfort with action. Professional traders respond with structure. When a professional misses a move, they do not chase, they wait. When they take a loss, they do not increase size. They continue executing the plan, because professionals understand something critical. Consistency is not built during exciting market moments. It is built during uncomfortable ones. Discipline is tested precisely when the mind wants to abandon it, and the traders who survive are the ones who respect that reality. To break the self-sabotage loop, traders need a simple mental checkpoint. I call it the pause before action rule. This rule contains 3 steps. Step 1, identify the emotion. Before entering any trade, ask yourself one question. What emotion is driving this decision right now? Is it calm execution? Or is it frustration, urgency, or fear of missing out? If emotion is high, the trade should wait. Step 2, reconfirm the plan. Ask a second question. Does this trade follow my rules exactly? Not close enough. Exactly. If the answer is no, the trade does not belong to your system. It belongs to your emotions. Step 3. Reduce decision speed. Most trading mistakes happen when decisions are rushed. Slow down the process. Take a breath. Look again. If the setup is real, it will still be there in 30 seconds. Speed often feeds emotional behavior. Structure protects discipline. This simple pause can interrupt the sabotage cycle before it begins. Trading success is not built on perfect analysis. It is built on consistent behavior. The best traders are not the ones who never feel emotional pressure. They are the ones who refuse to let emotions control execution. Because over hundreds of trades, small decisions compound. Breaking one rule today may not destroy your account, but repeating that pattern over months eventually will. Consistency comes from protecting your process, even on days when nothing exciting happens, even on days when the market feels slow, even on days when losses appear. The trader who protects discipline protects their future edge. In trading, the most dangerous opponent is not the market. It is the quiet moment when you decide to ignore your own rules. Because self-sabotage rarely feels dramatic. It appears in small decisions. A rushed entry, a slightly larger position, a rule bent just once. But over time, those small decisions form patterns, and patterns create outcomes. The trader who succeeds long-term is not the one who finds perfect trades. It is the one who learns to recognize their own destructive loops and refuses to follow them. Because in trading, the biggest breakthroughs often happen when you stop fighting the market and start managing yourself.